I mean, there's a big change here for people who are looking at their income from the entire year. They're analyzing their ordinary income, which is income from wages, it's income from work, it's income from earned income. And they're also analyzing their portfolio income and losses so that they can arrive at what they feel they're going to pay in taxes this year. There's some last end of year movements that you can make that might be additionally beneficial to you. A number of my clients feel like, hey, the market's going to continue to go down. And so some of them are moving money into treasury bills or moving money into safe havens, so to speak. Some of them are moving money altogether out of the market. As they're already planning to do some of these things, rather than waiting until January or waiting until the Christmas rush is over, they're proactively tax harvesting right now. And they're doing that, not trying to be greedy, not trying to wait until, market movements are adjusted based on spending habits, but they're doing that for purposes of getting everything set and in place so that come the holidays and come everything else, they don't forget to make some of these movements and changes that they are strategically doing, one, for rebalancing purposes, to adjust their investment holdings according to their investment objectives, and two, for tax harvesting purposes. Instead of giving mom and dad just cash, or instead of just paying their rent, you could consider gifting them stock and having them sell the stock, and then having them pay taxes on the sale at their lower rates, rather than you selling the stock, paying taxes at your higher rates, and then gifting them cash. Unless you donate that stock to charity, then you actually get this benefit of not having to realize for your tax purposes the growth of the holding period of that stock, but you do get the full fair market value of the stock based on the date that you gifted it to charity. For example, let's say you purchase a publicly traded stock at $1,000, and now it is worth $11,000. If you give that to a 501c3 nonprofit qualifying charity, you can get a deduction, not of what you paid for the stock. You get a deduction of the fair market value based on the date that you donated it, which would be the $11,000. And you don't have to pay any taxes on the growth from the $1,000 to the $11,000. People are asking about micro captives. One person says, hey, my accountant is telling me to consider a micro captive, or otherwise known as a reinsurance company. Wonderful. But then question mark, asterisk, isn't this an item considered on the dirty dozen list or the IRS's dirty dozen list? The answer is oftentimes yes. Not because it's a bad strategy, just because it's a strategy that has been in greater frequency abused, specifically by physician groups on the West Coast. The most egregious that I'm aware of that was disallowed was when they contributed from their operating company, their physician group. They took money from this company and they moved it to a micro captive, but not just a little bit. I mean, when you think of self-funding, or when you think of a sinking fund where you're putting money away for a rainy day, how much of gross revenue do you think of putting away? 10, 15, 20%. There is a right way to do this. And there's a 4-part check. A 4-part check that if you abide by this 4-part check, it becomes a very sound and reliable and defendable strategy. And to date, knock on wood, hundreds of clients later, we have assisted with individuals who do micro captives, and we help them do it the right way. Some of the things that we look for is that they have to be a part of a pool of other people with similar risks. There's a lot of different formulas out there, and I've done an analysis of over 12 different providers of this tax strategy. I'm going to call it a tax strategy, or people who help individuals with the setup, creation, and maintenance of insurance companies or small micro captive insurance companies. One such formula is that in the pool, you cover up to 50% of your own risk. Then the other 40 or the other 50% is made up of everybody else in the pool. That way you're participating. Should you have an insurance claim and you've put in $100,000 into your insurance company, you might have up to $200,000 of insurance. And should you only have one coverage and you have one claim and it's a catastrophic claim, you could get up to $200,000 back, even though you only put in one, because you belong to a pool. Now, one of the big questions here is, I put money in and I'm paying these fees and different things. How much of it am I able to deduct? Well, you have your operating business. And one of the reasons of putting money away for a rainy day is so that it's there, right? There might be some cost of the program and everything else, but fortunately, because all of this is a business expense to your main operating business, we are able to deduct the setup fees, the admin fees. We're able to deduct the renewal fees. We're able to deduct what they would otherwise allocate to their support team, their attorneys that do the promissory notes, their insurance underwriters, and if, of course, there's claims, the claims people as well. All of that is included in their fees that they deduct from what you contribute, and the full amount that you put in, whether you pay it separately in fees or it all comes together in one big check, that is deducted from your operating business. When I say deducted, it decreases your operating income, it decreases your net profit by that amount. Again, we have the 800 number and the website, strategictaxsolutions.com, the 800 number, 1-800-773-1848. You can find us on YouTube, you can find us on LinkedIn, on Facebook, review, subscribe, like, all that fun stuff. And let us know what your comments and thoughts are. Again, I help a number of financial advisors and CPA firm owners, as well as CFOs and tax consultants. So what is an alternative to these company retirement plans that might offer a little bit more flexibility, as well as a diversification of tax status in the future? Well, let's talk a little bit about life insurance. There is a way to put and hold life insurance in a defined benefit plan, as well as there is a business trust called a restricted property trust. Also holds life insurance as an asset. In both of these, it is restricted from the owner's actual current enjoyment and benefit in the moment of, which is why premiums, or let's talk about retirement contributions that go into the trust or the defined benefit plan, are able to be deducted. And kind of like a backdoor Roth, we have a retirement plan called a restricted property trust, where you're able to put away a substantial amount of money, deduct it now, and get it tax-free in the future. Leslie asked the date. Again, my office is here, and we're helping people fill out the applications, everything necessary so that they can purchase volcanic ash in bulk, this raw mineral that is being mined here in Utah, of all places. And it eventually is being processed, packaged, donated to Haiti, to a foundation there in Haiti that's helping people, with their nutrition, their diet, produce their own fruits and vegetables, so they're not self-reliant on the ships that are coming in with 80% of the country's produce. If we can help them grow some of their own plants, fruits and vegetables, and help their plants absorb from the soil the water and the nutrients and everything else that is necessary, because of this soil conditioner, which eventually soil fertilizer, soil conditioner is what this volcanic ash turns into. These companies have been around for a very long time, so you can buy into this partnership, participate in this LLC, you comply with the holding period that is required, and then based on your ownership, you can check the box to donate. You can donate the appraised value, or you can donate based on a 4 times multiple, the adhered to value of what it is worth when it's actually shipped to the foundation in Haiti. And essentially, you're getting a 4 times multiple on your tax benefit. What does that mean? If you put in $50,000, which $50,000 is the minimum, you get a $200,000 offset against your adjusted gross income, also subject to the non-cash charitable non-cash charitable contribution limitation. So if your income is $1.5 million, your adjusted gross income is $1.5 million, and you put in $50,000, you get a $200,000 offset. So your $1.5 million drops to $1.3 million. So if you're interested, give us a call, 1-800-773-1848. Somebody here in the office, Micah, Carly, myself, anybody else can help explain the strategy to you, your accountant, your estate planning attorney, your financial advisor. More than happy to help anybody and everybody so that you're not just making a rush decision at the 11th hour, but you're actually making a conscious, deliberate decision about your taxes and about what is efficient.